Okay, so now over here we're going to discuss options. So we will go through the option characteristics, the call option payoff, the put option payoff, and lastly we will briefly look at the option pricing as well. So what is an option? A contract that gives its holder the right but not the obligation to buy or sell an asset at some predetermined price within a specified period of time. So now you have already studied forwards and futures. You should be able to differentiate an option from that. A forward and future was also a contract that gave the holder the right to buy or sell an asset at some predetermined price within a specified period of time. What is the difference between an option and a future? The difference is that, yes, an option gives its holder the right, but not the obligation. So it means the holder is not obligated to actually use the option. Like the name suggests, option, which means choice. So it is the holder's choice whether they will exercise that option or not, whether they will use that option or not. Whereas in a forward or future, it is a binding contract that you cannot, um, that you will have to make due. So most important characteristic of an option is that it is not obligated its owner to take action, it's a choice. And it merely gives the owner the right to buy or sell an asset. So let's do a comparison between futures and options. Future contract is a binding agreement. So if you have agreed that you're going to buy something 3 months later, then you will have to buy that thing 3 months later, or you can close the futures contract, which means you can sell it to somebody else before the end of the contract. For buying and selling of a financial instrument at a predetermined price at the future specified date. Options are the contract in which the investor gets the right to buy or sell the financial instrument at a set price on or before a certain date. However, the investor is not obligated to do so. So it is not compulsory for the option holder that they will have to buy the asset. If they want, they cannot use that option. They will not buy the asset. Okay. So obligation of the buyer, yes, to execute the contract. No, there is no obligation. It's a choice. If you want to use it, use it. If you don't want to use it, then don't use it. Execution of the contract will be on the agreed date. And in options, it's any time before the expiry of the agreed date. So this is one more difference. For example, in futures, if your option is for 31st December, it means on 31st December, you will have to buy or sell whatever asset was in your contract. Whereas if you have bought an option, that means you have to use that option before 31st December. So you can use it on 28th, you can use it on 27th, you can use on the 1st of December. But after 31st December, you can no longer use that option. The option has expired for you now. So if we talk about risk in futures, the risk is quite high, whereas in options it is limited. Now, why is the risk in futures high? The reason is that the degree of profit or loss is unlimited in a futures contract. There is no limit to the amount of profit or loss that you might earn if you have purchased a futures contract. Okay, so go back and see the payoff diagrams that we had studied previously. You will see that the section on the loss is actually unlimited. And in options, you have unlimited profit and you have limited loss. So options are better in the sense that you have the chance to earn unlimited profit, but your loss has been limited. Because of that, the risk over here is limited. And also because of this advantage, you have to pay an advance payment if you're going for option. So if you purchase an option, you will have to pay an advance payment in the form of premium, which is going to be the option's price. But if you are going in a futures contract, there will be no advance payment. So some more option terminology. There is a call option. You've already studied forwards and futures, and remember we studied over there long and short. So long was a buying position, short was a selling position. Similarly, in options, we have different terminologies. In options, a call option is an option to buy an asset at a certain price by a certain date. A put option is an option to sell an asset at a certain price by a certain date. So over here we call the call option to refer to buy, and put is referred to sell. Now we have the exercise or strike price, the price stated in the option contract at which the security can be bought or sold. So this is the price at which the trading will take place, which was called the forward and future price in our previous questions. Now it is called exercise or strike price. So it is the price at which you have agreed in the option that either you will buy or sell the asset. For example, if you have agreed that I will buy it for 100, then this is the strike price. Now the original spot price can be anything else. The option price, the market price of the option contract, is the price at which you will have to purchase the option, which is also called your option premium. So this will be an advance payment that you will have to pay, and if you do not use the option contract at all, then the premium is the limited loss that you will have to bear. So if you have paid 5 rupees to purchase one option and you did not exercise that option, then these 5 rupees are lost. You will not get them back. Now, what is exercise value and intrinsic value? Basically, your option premium that we have discussed has two components. Its price has two components. One is called the exercise value, and the other is called time value. By exercise value, also called intrinsic value, we mean the exercise value is what the option would be worth if you had to exercise it immediately. So what is the profit, in other words, that you will get if you exercise your option immediately is called exercise value. For call, if you want to calculate the exercise value, the formula is current stock price minus strike price. Now, this is again very similar to your forward and futures. Remember, for long, what you used to do. Similarly is going to be the case for call. So call is for buy. If you want to buy, you want that your price should be less. So you can see that strike price is coming this way, and you want this to be less so that you can have a lot of profit. For example, if the current stock price is 120 and your option allows you to purchase it for 100, then you will have a profit of 20. So over here, you will benefit when your strike price is less. The price at which you need to buy is lesser than the current stock price. This is the situation that you want. For put, remember, put is for sell. So when you're going to sell something, you actually want your price to be higher because you want to sell at the highest price possible, right? So over here, you want the strike price to be more, and you're going to benefit when the strike price is more. So let's say the strike price is still 100, but the current stock price is now 80. So you can sell it for 100, whereas the stock price in the market is for 80. That means a profit of 20. Now, time value, it's at any one point in time, the value of an option may be greater than its intrinsic value. The difference between the value of an option and its intrinsic value is time value. Basically, you can see that the intrinsic value came 20 in both cases. Now, for example, if you bought this for 25, so if the premium was 25 and 20 was related to the exercise value, then 5 you paid for time value. Time value simply means that, the stock market or any other market is volatile. So the longer the duration of the option, the higher is the chance that most probably your loss will turn into profit. So you're paying extra money because the duration of the option is more. So for example, if the duration is 3 month long and another has a 6 month long duration, then the time value for the 6 month one will be more because the volatility will ensure that at some point you will be able to exercise the option. Okay, so these things will become more clearer when we actually do the practice questions.